Guten Abend, meine Damen und Herren. Willkommen in der Österreich-Amerikanischen Gesellschaft. Mein Name ist Rainer Newald, ich bin Generalsekretär hier im Hause und weil der heutige Abend in englischer Sprache stattfindet, darf ich jetzt auf Englisch umschalten. Welcome, ladies and gentlemen, to this evening, our Super Tuesday series. We are talking today about Wall Street issues. It's our second issue, our second part of the series. Welcome to the Austrian-American Society. Welcome here in Vienna. We have all our guests, our members invited here, and they are live here with us on Facebook, on YouTube, and also with our media partner, Der Standard.at, who is streaming today our event from here. I'm very glad that you're with us here. Just few organizational issues before I hand over to our moderator. This evening tonight will be also can be seen also on demand on our website and also on our Facebook site. Come to us and visit it and watch it afterwards if you don't have time. We're very glad to have these high level guests with us. And now I wish you a wonderful evening, interesting issues. And if you have some questions, please send them to us over the Zoom chat mode or over email or on YouTube. You can everywhere send us questions. And I'm very glad to hand over to our Vice President and the moderator of tonight, Mrs. Monika Rosen. Have a good evening.
Thank you very much. Good evening, ladies and gentlemen. It is my pleasure to welcome you to tonight's panel, the second in our Wall Street series. My name is Monika Rosen. The markets have given us quite a bit food for thought lately. They always do, but perhaps a little more so than usual in the last few days. The world is heading into another corona winter. The Delta Variant seems to be subsiding ever so slightly, at least here in Austria. Whether that will remain the case once temperatures dip remains very much an open question. At the same time, at least the American central bank, the Federal Reserve, has made it clear that they want to tighten the purse strings ever so slightly. Bond purchases will be ratcheted down. At the same time, an interest rate hike is dawning on the horizon. The markets have taken all this in their stride, or I should have said equity markets have taken all this in their stride. Or have they lately? A little bit of nervousness is creeping into the system. And last but not least, in this short tour d'horizon that I'm giving you, there is the 800-pound gorilla in the trading room, if I may put it like that, and that is China. They are cracking down on tech stocks. They are cracking down on crypto. And with Evergrande, one of their largest real estate conglomerates, teetering on the brink, so far that has had very few repercussions in the markets. Again, the jury is still out if that remains to be the case. As you can see, ladies and gentlemen, there is a number of pots simmering. We plan to lift the lid on all of them. As Rainer has already said in his introduction, most of all, we wish for you to post in your questions, whether you're here in the room with me or whether you're following us on any of our channels. If there are any subjects that you wish to see discussed, please make yourself heard, and we would love to hear from you. Now, if there ever was a Wall Street evening deserving of that name, it has to be this one. We are extremely happy and extremely privileged to welcome a guest coming to us from Wall Street or just around the corner from there. Please help me welcome, ladies and gentlemen, Davide Andalo. He is Chief Market Strategist at Goldman Sachs Asset Management. He comes to us from Goldman headquarters in Lower Manhattan, next to the New York Stock Exchange. Davide, it is a pleasure to have you. Welcome, and thank you for being here tonight.
Thank you, Monica, and thank you all.
I hope you can hear the audience cheering. Now, Europe, ladies and gentlemen, is not to be outdone and will respond in kind. From Frankfurt, live, we welcome Dr. Jörg Krämer. He is chief economist at Commerzbank and the member of the Shadow Council of the ECB. It is a pleasure and a privilege to have you, sir. Welcome. Thank you very much.
Yeah, thank you very much for the invitation. Happy to be with you.
Here in the studio, ladies and gentlemen, in Vienna, the man by my side needs the man by my left side, on the right, we've already heard, needs absolutely no introduction at all, I am sure. Welcome, Peter Brezinschek. He is chief analyst at Raiffeisen International. Thanks for being with us tonight, Peter. Thank you very much.
Thank you to be with you.
All right, I will start out with Frankfurt, if I may, because in my list of issues that I started out with, I left out by choice the perhaps most current one, and that is the outcome of the German election. 2 days ago, the Germans headed to the polls. An era came to an end. After 16 years, the era Merkel is over, and perhaps the way things seem to be going, the conservative rule seems to be running out of steam here a little bit. So we are looking at a variety of choices in terms of coalitions. And the question then becomes, what will the markets make of all this? What about yields? They've been certainly rising lately. What about equities? Dr. Krämer, fill us in on that topic, if you will. Thank you very much.
Yeah, thank you very much. Now, well, I think the good news on the Sunday evening was that a coalition between the Social Democrats, the Greens, and the former East German communists, the left, they failed to win a majority. And this is very important because the Social Democrats under Mr. Scholz, to form a stable government, they need to convince the liberal FDP party to join them. And the Social Democrats, they can no longer threaten to instead form a coalition with the Greens and the left. And therefore, this greatly enhances the bargaining position of the liberals, which are very much pro-market. And therefore, I think a slide to the left in economic policy in Germany is quite unlikely. Regarding future coalitions, I see an 80% probability for a government led by the Social Democrat, Mr. Scholz, and joined by the Greens and the Liberals in the end. However, this is not a foregone conclusion. You have to understand that in terms of economic policy, the Liberals tick totally different than the Social Democrats and the Greens, who rely more on state intervention. I give you one example. I have here a list of from the party election platforms. For example, the Greens and the Social Democrats, they would like to raise the minimum wage to 12 euros per hour. They would like to cap rents. They would like to introduce a wealth tax. They would like to increase income tax. And they would like to abolish private health care insurance. You see, this is not a natural fit. That means that the liberal FDP joins a government led by the Social Democrats and the Greens. But in the end, what is the alternative, you know? And therefore, I think I see an 80% probability. However, if for whatever reason the liberals failed to get convinced to join a coalition led by the Social Democrats, then the alternative would be that we get what we call here a Jamaica coalition. That means a coalition of the Christian Democrats, the Greens, and the Liberals. But I think this is not easy because the party members of the Greens, they anyway tend to have more in common with the Social Democrats. And they do not have a lot of incentives to put the election loser, Mr. Laschet, back or in the chancellery. Therefore, we cannot totally rule out a coalition in the end led by the Christian Democrats, but unlikely. Only in the case that Mr. Scholz, in contrast to expectations, fails to convince the liberals. Another alternative, last point I would like to mention is you also cannot totally rule out a grand coalition, a new coalition, but then, of course, led by the Social Democrats.
Thank you very much. Okay, so that was a tour d'horizon, but I think what I'm taking with me is that there's quite a bit of relief in the markets. Yes. Perhaps under the headline, it could have been a lot worse. Okay, so America has its own issues to contend with, so we switch over to Davide. What about the debt ceiling? What about Mrs. Yellen testifying before Congress today, telling them they're going to run out of money October 18th? That's not even a month to go. How are we looking in terms of the economic outlook as far as the U.S. is concerned, Davide?
Yeah, absolutely, Monica. There is, as you said, a certain amount of urgency to the matter. Janet Yellen has been vocal on few occasions, and the funding is not the only issue that they are discussing right now in Washington, D.C. There is the funding, the financing, and also the fiscal reform, both the Building Back Better and the bipartisan infrastructural plan that they would like to put through. So the timings are uncertain, the amounts are still uncertain, and for sure this could create some dislocation in terms of market volatility. However, there are also resolutions in sight, and we think that eventually we can see the situation resolving. Broadening this out to the outlook for the US economy, look, we have seen some deceleration in recent months, given by the fiscal. Of course, we all knew that from a net positive would become a net negative. And the second one was the outlook of consumption. And this has been, in our view, just delayed, not derailed, because of the Delta variant. We think further down the line that growth is still relatively stable. We are at 4.6% for next year. Consensus is the 4%. And if you broaden out a little bit, not only talking about growth, but other variables on the macro side of things, we see limited amount of financial excesses. Financial conditions are still loose, actually ultra loose, and this is, of course, a good thing. Corporate fundamentals are good. So yes, as you said, the Fed is also intervening a little bit. The meeting was a little bit more hawkish than many expected. And as you start to take out a little bit of liquidity in the system, you might start to see some volatility. But we want to look through this, and we think that the environment, of course, is still a positive one, even if we have some hiccups in the way. And when it comes to the markets, we think it's very important to maintain a very active approach right now. Speed is alpha, really. A lot is happening, as you said. We are watching it carefully, but our overall take on the outlook remains a positive one.
Good to hear, and of course we'll get into more detail about that in just a little bit as we drill down further, but I would like to double back to the German election with you, Mr. Peter Brezinschek, for just a moment. Perhaps you can give us your take with your unique insight on the Austrian market. Has it reacted to that, and if not, why not? Or how so?
Yeah, first of all, I would like to share also some thoughts with Jörg. He has given on the consequences of the German elections from Sunday. I would like to draw three lessons from that. First is, as Jörg mentioned, the Germans don't want a left-wing, red, green, dark red coalition. That's the good news. Secondly, the Germans want to have a greener policy, but they don't want to have a climate protection measures that should predominate all the political issues. And that is why the Greens have fallen back to levels of 15% against polls of 25% in the summer months. And thirdly, what I think Mrs. Merkel has accustomed the Germans to social democratic policies. And the Germans want to continue that policy stance. And logically, I suppose, this traffic light coalition of red, green, and yellow will meet all these factors and might be the most probable outcome. But I disagree that this might be the favorable development for Germany, and I also disagree that we should bet on an 80 to 20% probability, because it can happen that in the next weeks or even in the next days, Mr. Laschet will step back and we have a successor, which is much more accepted as a new start of political development in the union parties, and has a better standing and a better acceptance by the Greens and the Liberals. So for a market-oriented solution, which is welcomed by the corporates and by the financial markets, I see a good chance that after long-lasting negotiations on this coalition, it could turn out that even also the conservative parties may be part of this ruling coalition. And I suppose this Jamaica would be more welcome, despite some harsh climate change measures, which will be the price for the Greens to join them. With regards to Austria, we have seen that the Austrian stock market has even reacted more positively than the German market, which was then loosening its steam in the afternoon. And when we look at the current development, other issues are more offsetting the news of that. As we know, we have a very long period before we get a new government in Germany. Remember, in the Netherlands and in Belgium, we had periods of 1 year probably to get some new decision makers in the power, and I suppose we have to be patient with respect to the coalition building.
Heaven forbid, Peter. I hope it's not going to drag on for a year. Scholz has said he wants to be done before Christmas, so that is something to look forward to. Now, Davide, okay, so we've talked about the German election, and I am surrounded by optimists all the way around. Everybody is optimistic that this is going to end well for markets. Wonderful. Now, lately, U.S. yields have been rising quite steeply. We have crossed the 1.5 threshold on the 10-year U.S. Treasury. So first of all, give us your outlook, the outlook of Goldman Sachs on monetary policy in the U.S. And then, more importantly, perhaps tell me when will these yields, how far are they going to rise, and when will they start causing a real problem for equities, if they have not already begun to do so?
Okay. Yes, the answer to the last question is no. We are not there yet. Of course, there is still much further to go. But it is true that yields started to sell off quite meaningfully over the last few sessions. Not only the 10 years, also the 30s. Yesterday hit the 2%. Mm-hmm. So this yield curve is steepening a little bit, which can also mean positive news, because a stronger economy needs a little bit of a higher yield curve and steeper yield curve. So we are not particularly concerned about that, Monica, also because we started from a position where yield were unsustainably low for the level of economic growth that we are experiencing, for inflation expectations. So these yields had to come up, and now they're starting to come up. But also the trigger perhaps was last Tuesday, where the dots projection were different than what the market expected. Now we have half dot for 2022, meaning 50% probability of seeing one interest rate hike in 2022. And this is something that the market didn't expect. But more than that, I would say, it's very interesting to look at the FOMC projection of core PCE for 2022. The number is 2.3%, but actually there was good dispersion.
Davide, just to be sure that everybody follows us, you're talking about the inflation projection, okay? Is that what you're talking about?
The core PCE is the measure that the Fed looks when we look at price pressure. So that means effectively that tapering now can be on the table. As we know, November, in our view, is the likely start date. And we are talking about 15 billion per month. This would mean that we would see an end of tapering towards the middle of 2022 and potentially a start of the hiking cycle in 2022. We don't agree necessarily with this view. We think that the situation will be a little bit lower for longer. We have a first interest rate increase in 2023, but we need, of course, to wait and see because a lot can happen from now to then. So the monetary policy stance right now is pretty much well telegraphed by the Fed, and we think that in November, effectively, they would start to announce tapering.
All clear. I think we have a question from the audience. Rainer, please go ahead.
Okay, thank you, Monika. We have a question from one of our viewers from the Standard, from the website Standard.at, who just wrote me an email before, and he's coming back to the topic of Germany, what we just mentioned before. And there's the question: will the German elections and the outcome of the German elections have an input on the ECB monetary policy and generally on the policy of the European Union?
Well, I think, Dr. Kramer, that question says Kramer all the way around, doesn't it?
Yeah, absolutely. I assume so. Well, the ECB is independent. However, we know this is correct de jure, but not de facto. And therefore, there is, of course, an indirect influence of the German elections on the ECB. And it depends whether the liberals will prevail to prevent to prevent debt mutualization to become a permanent thing in the Eurozone. And this is a big question. You know, the Social Democrats, Mr. Scholz, and the Greens, they would like to make debt mutualization, which we already have seen in the Corona Reconstruction Fund, they would like to make this a permanent thing, and the liberals are against this. For the liberals, it's a high conviction call, and therefore I assume that they will prevail with a probability, let's say, of 60 to 40%. That means there is an outside risk, I would say, in my view, not a chance, or an outside probability, let's put it neutral, that a new German government would go to a policy of permanent debt mutualization, which may put some pressure off the ECB. But whether the ECB in the end would then take the opportunity to start a rate hike process or the tapering a bit earlier, I don't know, because the ECB Council is anyway dominated by the DAFs from the highly indebted countries, primarily from Southern Europe, and whether a bit more leeway on the fiscal side due to Germany's okay to a permanent debt mutualization, whether this really would cause the many DAFs in the ECB Council to say, okay, let's start the tapering a bit earlier. I doubt this. Therefore, in the end, influence on the ECB only at the margin.
Thank you very much. Okay, yes, Mr. Breitinger, you wanted to add something?
Yes, I want to respond to that. I think the impact is indirectly. As Jörg told us, there are some milestones in the economic program of the Social Democrats and of the Greens. That's the minimum wage. You have wealth a wealth tax. You have maybe more ambition to increase the carbon taxes from the current perspective, and all this might add also with a loosening of the fiscal stance to a higher inflation rate. And the inflation number maybe will be crucial then for the ECB, firstly to change the forward guidance, and then possibly also to react on the quantitative measures. I don't think that they have in their mindset now a change in the interest rate environment, but it is not ruled out even after the last ECB Council that the accommodation policy stance of the ECB might also have a mixed approach of some termination of the quantitative easing during next year, and step by step then going upward with the conditions of the TLTROs, the so-called long-term refinancing operations, which are much more important for markets and for the banking system than the asset purchase programs of 20 billions or 80 billions. And that means if that is on the horizon, I think that will also have an impact then on the equity markets. If we see a come from the minus 0.5% up to the 0% level in the next 3 to 5 years. And that might be then also accepted probably by Mr. Visco from Italy as the governor, as they are more in favor from the southern states of a quantitative measure approach than of leaving the negative interest rate environment. Because that's also a taxation on the Italian and the Spanish banks regarding the increasing deposits they have as the incoming level in consequence of the high savings ratios.
So what I'm taking away from all these statements is, first of all, that the ECB is unlikely to raise rates in the next 2 or 3 years. I take it it'll take a while.
Yeah.
This PEP program, asset purchases by the ECB to support the economy in the pandemic, will end, at least as it stands now, in March of next year. Whether or not that will be extended beyond that, I think is still unclear. Okay, before we leave these topics, or this range of topics here, there is one term that I would like to see discussed because it gets bandied about ever so often, and none of you gentlemen are young enough to remember, but I do remember the 70s, and we had the never mind.
Okay.
Peter. Never mind, Peter.
I have to intervene.
I was trying to be
Monika.
polite. I was trying to be polite. Okay, but anyway, so we had the concept of stagflation. So no growth, but still inflation. Mm-hmm. That seems to scare markets quite a bit. And of course, we know that the 70s were nothing to write home about in terms of equity performance. So how do we feel about that? Is that a clear and present danger? Or is that just something that gets quoted in the media, but we shouldn't really worry about that? Would any of you gentlemen like to share a view on that, please?
Well, may I?
Yeah, please go ahead. Yes.
Well, as far as stagflation is concerned, you're right, stagflation, this is something which describes the whole 70s. And currently we have a situation in the fourth quarter of a growth slowdown. I expect growth to slow down to nearly 0% in Germany, for example, in the fourth quarter. And of course, at the same time, in the fourth quarters, we may even hit a 5% inflation rate in Germany. Okay, formally this may be described as stagflation, but we are talking about only the fourth quarter. I'm a critic of the ECB, but I have to admit, I think that after the turn of the year, inflation comes down. And this speaks against stagflation. Moreover, I think that the very expansionary monetary policy will fuel growth going forward. That means this is a kind of bubble economy which we are likely to see in the next couple of years. And only once the labor market gets tight again, and only once we see that wage growth in the Eurozone really accelerates, which maybe, I don't know, in 3-4 years or so, only then we get really the problem of higher inflation. But then I think we get no stagnation, but we get a recession, because a burst of overvalued real estate markets, etc., this will not only cause stagnation, but a deep recession. Therefore, I think, to answer your question, stagflation or stagflation may be a good description of what is ahead in the fourth quarter, but it's a bad description of what we expect for the next 3-4 years to come.
Yeah, I would agree with you, Jörg, in the sense that it's really important here to extend the time horizon as much as we can. We come from a very unusual cycle. Numbers are unusual numbers to what we normally expect to. Inflation, has been higher than normal, has been deemed transitory here in Europe. And as long as inflation expectation will remain pretty much there, this is going to be the case. But if we then move from inflation to growth, of course, the number we are seeing now are a little bit biased upward because of the hit we got in 2020. But going into 2022, we see growth decelerate into a more normal but sustainable pace of environment. Monika's question is a good one because history rhyme doesn't really repeat itself. It's interesting to look at history at what was similar and also maybe not to repeat the same mistake that were made back then. So I think it's important to really extend the time horizon and look at the 2022 and 2023. And this is what central banks do when they, look at how to set policy.
Well, did you wish to add something?
Yes, of course. I think stagflation is not the name of the game. The positive news which we observed since last summer, I have to say, even in the second and in the third shutdown phase, was the robust development of gross fixed investments and the construction area as well. So what we see since this time is a constant and permanent increase of gross fixed investment, leading the business cycle for a longer lasting development of the next 2 to 3 years. It's not based on private consumption. I think there might be some savings or excess savings back in the goods market in the next couple of quarters, but the driving force basically is actually the gross fixed investment. And that is also a positive news for productivity growth in the long run, and that might be also influencing some higher wage growth, which might be the outcome of the wage negotiations going forward right now, what we see in Austria, for example, or in some other countries, or in the US with hourly earnings going up more than 4%. So, I mean, it's a very healthy development of the economic components of growth to go forward into 2022 and 2023 to have above average growth rates of 4.5% next year, 2.5% in 23, and that means with the declining trend and the diminishing pressure on prices from the energy sector, from the intermediate goods, for example, we will see a moderation of this combination of price increases and of the growth figures. So I suppose it's an favorable environment, even also for financial markets conditions.
Wonderful. You've just hit the nail on the head here, because I was going to say 30 minutes into the discussion, about Wall Street, why don't we finally talk about Wall Street? All right, so Davide, we have a premier strategist, not just somebody, a premier strategist from Goldman Sachs Asset Management with us tonight. What is Goldman Sachs' view on the US equity market? I mean, I dare say we have a lot to lose. Markets have been on a tear, yields are rising. I mean, I'm surrounded by optimists. I'm very happy to hear that. But I mean, as they say, could something go wrong conceivably, or is it all hunky-dory from here on out?
There are, of course, hiccups that we can see, and volatility at the end of the day is a healthy expression of market functioning. As I was saying before, right now the market are digesting a lot of different unknowns, and this is what is creating a little bit more volatility, coupled with the Fed, which is starting to withdraw monetary stimulus. The market has recovered already a lot compared to the trough back in 2020. We all know about that. But what's important right now, looking at 2021, is that all the rally has been really explained by earnings, has been an earning-driven recovery. It hasn't been just based on multiple expansion. And earnings continue to be key as we move through this part of the economic cycle. It's also important, Monica, to moderate a little bit return expectation going forward. A 20% return per annum is something that we just don't see from a strategic asset allocation perspective. The recovery we've seen so far was really front-loaded because we've seen a lot of stimulus coming from the policy side of things, coming from fiscal, monetary, and this has created a really good rally in 2021 year to date. Our target remains a positive one. We have a 4.7% at the end of this year, 4.8 at the end over the next 12 months. So moderating return expectation as we go through. Of course, the risk remain, but eventually volatility is back and it's a little bit of a normal behavior. The outlook remain positive. Equities continue to be the asset class that we prefer compared to rates, for example. We've already seen a lot of gains in 2021 and compared to, of course, rates, where now we have seen some upward pressure. So overall, in terms of equity strategy, equity is still the place to be, and we would recommend to stay invested even if we are seeing some drawdowns in these days and the volatility can be a little bit bumpy further down the road.
All right, okay. I think that is probably a view that most portfolio managers, I dare say, can get behind. Anybody wishes to add to that? Or perhaps even then we could easily also talk about growth versus value, rising yields, tech stocks, FANG stocks. Will they come under pressure now that energy prices are rising, yields are rising? What's the story there? Mr. Brzezinski, yes, go ahead.
Okay.
Go ahead. Yeah.
Okay. Maybe I have pointed out too much on the medium and the long run in my remarks prior to my statements. I would say it's very much exciting what we are now experiencing in this environment in the equity markets. To be honest, I haven't seen any skyrocketing of equity prices within 20 months to double the Standard & Poor's 500. And to be frank, I don't see that was accompanied by 100% earnings increase. There is some multiple expansion we have to witness also. And if we compare that with 20 years ago, with the dot-com bubble, for example, with multiples of more than 30 times earnings, I think it's now entering a vulnerable phase of the equity prices in the near term, in the short term, when it is confronted with a discussion of a change in the monetary environment, as you have elaborated, that we have a more hawkish view now on the Federal Reserve policy. So we have good fundamentals driven by strong earnings. Also 2020 2022. But we are also faced with some headwinds from the politics. I think Biden administration is devoting to more attention in inequality, social security, climate change. That means that we have some burdens for the corporates to take into account, even tax increases. I think that is not a very favorable situation for equity investors. But I fully agree, stay in equities, because when you take the long-term view, is there any alternative to equities to earn real yields? I don't see any other asset classes at all.
Yeah. Yes, go ahead. Yeah, go ahead. Briefly, and we have a question from the audience, but go ahead, Dr. Kramer. Yes.
Yeah. Thank you very much. When you remember Monday last week, the German equity market and other equities started very weak, but they recovered so quickly. That means this was, again, a sign. There is a wall of money. That means a lot of investors, if there's a dip, then they buy. And the story behind this is clear, because central banks, they de facto have lost a good part of their independence. And therefore, their monetary policy remain accommodative much longer than in the past. And therefore, we have what I call an asset price inflation. And this asset price inflation only comes to an end once we get real CPI inflation. And this is not yet this year or next year. For real inflation to come, we have to wait a couple of years. And only then, all this huge increase in money supply, until then, the huge supply and money supply will primarily inflate asset prices. And I think this period of asset price inflation is not yet over, which is why I think that buying on the dips makes sense.
Yeah, I just wanted to add, Jörg, that when we look at valuation, for example, we don't need to look at equity in isolation. We need to look at equity versus credit versus rates. And in an environment where rates are at 0, real rates are at -2, it's normal to see equity multiples a little bit higher than what was the case back in the 80s, where the interest rate was 5%. The equity risk premium, so the premium you get investing in equities compared to rates. And to Peter's point, of course, volatility is something that we need to tolerate, but right now the situation, in our view, remains positive. And then on the growth versus value, Monika, if you want me, I can touch quickly on that. It has been really difficult historically to time reversion.
Can you hold the thought for just a second? We have a question from the audience.
Sure,
we'll get to growth versus value in a second. I'm trying to squeeze that in. Please go ahead.
Okay, Davide, sorry, because it was like coming back to your to your statement from before concerning volatility, and there was something what Mr. President Jack also mentioned concerning China, especially China. Does China at the moment is very volatile. Coming back also to the cause with Evergrande and all these things. What will be the long-term outlook on China, and does the Biden administration now have an impact on volatility on the capital markets worldwide? So, Mr. President, did an answer already on that before, but concerning China, was it this one?
Would you like to take that, Davide, please?
Yes, sure. When it comes to China, the importance of China in the global economy in 2021 is surely something which is new compared to 10 years ago, 15 years ago. And of course, if China sneezes, they say the world can take a cold. However, we also think that more than the episode we have seen with Evergrande and the nature of what this can mean to the property sector in China, we need to look at spillovers as well. And right now, the spillovers seem to be relatively contained. It's also true, though, that over the very long term, we need to look at what are the motives behind behind the government push towards all this reform, all this tightening. And at the end, the quality of growth is now a clear objective for the government. So we can have a lot of volatility on the way. And if you look at the past, every 2-3 years, there has been an increase in risk aversion around the investability in China. 3 years ago was, for example, the trade war, and then in 2015, the CNY episodes. But every time the market has managed to come back up stronger and bigger than before. So if you look strategically over the next 7 to 10 years, this economy will continue to have a central importance over the global economy. Of course, every now and then you have this tightening, but also looking at the reason why this has happened, probably it is not all bad. Actually, it can be good over the very long term.
I have to say I have a different view.
Yeah, go ahead, Dr. Kramer. It's all right. Go ahead.
As I said before, I think equity markets are part of remain part of an asset price inflation. Therefore, I remain optimistic in general on equity markets. But regarding China, I'm much more cautious. You have to see Evergrande is only a symptom of a deeper problem. You have the government resumed the deleveraging campaign. That means they would like the big companies with high debt to lower the debt, and this means less investment. They introduced caps on apartment prices, which is negative for the construction sector, which is for 20% of Chinese GDP. And there's a tendency to go to implement an autarky kind of foreign or external policy as far as exports and imports is concerned. And this weighs on productivity. And productivity grows in the past decade, total factor productivity. The advance was not even 1% per annum. And combine this with the negative demography, which is when it comes to the number of people in working age, they decline in percentage terms roughly about the same amount as in Germany. That means both from a cyclical point of view and from a structural point of view, I think there is disappointment in the pipeline regarding China. As I said, this does not change my constructive view on equity because this is primarily based not on China, but on my asset inflation story.
We have, okay, may I just interject here, and I think you can provide an answer, Peter. We have a question that plays into this China topic, in my opinion, because it talks about supply chain disruptions. What about them? Are they transitory or permanent? Well, let's hope they're not permanent. And what is the potential impact on growth and inflation? And I think with the port closures in China, etc., that is also a question that is remotely, at least, related to China. Who would like to go first?
It's related to China. May I?
Yeah, please go ahead. Go ahead. Yes.
Because it also makes it easier to respond to the former question, because the Chinese authorities have changed already their primary goals for the economy and the society. Inequality is now addressed as one of the primary goals and not maximum growth rates. And that has shifted, as Jörg told us, that the very much leveraged real estate groups and the non-financial corporates are targeted to leverage down and to lower the debt burden. I'll give you an example. Before the financial crisis, the household debt and the non-financial corporate debt was 80% of the GDP, and now it stands at 200%. So that's not comfortable for not only for the government, but also for the whole society to have a smooth, accommodative policy going forward for making inequality as a major target to overcome. And in that respect, we have also seen some sharp restrictions affecting the transportation sector, also the container sector, the shipping, which has been raised the rates extremely from 1 year ago, now more than quadrupling to to current levels, and that has also caused some actually very strong interruptions in these supply chains. And this leads us also in Europe and in other parts of the world to reconsider is the current business model the appropriate one to rely on one supplier in textile, in pharmaceuticals, in very important products of sectors. And therefore, I think we see some reshuffling of these supply chain activities. And that leads me next. That may also cause higher prices, probably, and fill some long-term factors to the inflation story. So on the long run, what I have not elaborated right here, I was talking about the short run for the next 2 years, but on the long run, there are some elements we have to take into account considerably for higher inflation numbers in the next 5 to 10 years that will materialize. And that's not talking about decarbonization and the carbon tax. So I think there are some of these supply chain developments, globalization versus regionalization in the cards, which are very much important to take into account.
Time is marching on, but we have not touched one asset class that I think deserves a lot of attention these days, and that's commodities. We have not talked oil price or energy at all. So Brent just crossed $80 a barrel. Energy prices are clearly on the rise. I mean, if you remember spring of last year, the US oil price was negative. Anybody remember that? That seems a distant memory. So what is the outlook on energy prices and perhaps even on, as Peter mentioned, decarbonization and all these climate change initiatives? I would like to get into the topic of commodities, energy, or any other commodity that you feel merits our attention here. Does it have a place in your portfolios, perhaps? Davide,
okay.
Would you? Yeah, go ahead.
Let me start, of course. When it comes to oil, yes, we just crossed 80 on the Brent. Our view actually from now to year end sees a 90 in the Brent, so a little bit more room to rally. Of course, this has been driven more by demand, as we know, compared to the supply, and also recently we've seen the demand picking up higher after this Delta Variant scare. So when it comes to energy, the outlook remains positive. When it comes to other commodities, though, for example, gold, we have seen gold pretty much range bound this year, and you have different elements there. On the one end, you can still have strong demand, but on the other end, you might have a little bit more worries if rates have to rise, and you will see some real rate component to it. Generally speaking, commodities has been an asset class we've seen positively this year. And just to answer also your question from a portfolio standpoint, and then I leave it to my colleagues. From a portfolio standpoint, it's an asset class with a lot of volatility, though. Historically, if you look at commodities, the volatility has been higher than that of the S&P, for example. So we need to also consider how that fits into the spectrum. Gold is a clear example of this. Long-term return haven't been really that great. Volatility of the asset class is particularly high, and so other asset classes, in our view, can offer more of a predictable behavior if it is to, buffer the impact of equity drawdowns, for example, high quality fixed income, or if it is to provide growth and capital appreciation over the longer term. So, for example, equity has a bigger role. But the overall outlook on commodity, going back to the tactical, it's positive, and oil can continue to increase by year end, and then eventually to come down a little bit by middle of next year as supply starts to ramp up as well.
Excellent question. Would anybody of the other two gentlemen like to comment on that? When do you think this energy or this oil price rally runs out of steam? Interesting point there. Go ahead.
Okay.
Go ahead,
Okay.
Peter. Yeah, go ahead.
Okay, I suppose we are close to the peak in this current environment. I have to admit we haven't seen the $80 for Brent per barrel in our forecasts for the fourth quarter, but basically we see that more and more supply side effects will be valid and will be dominating the next year, so that we have a decreasing pace of the oil price in the course of 2022. A different view, I suppose, is what we can expect on natural gas, because natural gas has been exploding in the last 3 months, doubling from 3,000 to 6,000. Today, I think we have seen the spike of the oil of the natural gas price with a 10% increase, and now retreating substantially to the opening price again. So there is a lot of speculation, not only because the Russians are delivering less natural gas to Europe than expected, but also the very low inventory numbers are always filling this speculation about higher gas prices. And it's also an interesting fact that this, let's say, termination of the nuclear power and of the coal power stations has made some revival of the gas prices, as we need a steady source of energy to produce electricity, because wind and solar energy is not always available, as we have experienced in the recent summer months, and therefore I see a rethinking of these energy plans of a decarbonization has to be taken into account. Also, what are the steps to find a steady power solution, which is substituting the missing power of wind and solar energy, and therefore I think we have to deal with higher gas prices longer than with higher oil prices. That's my view on that.
Oh, okay. Dr. Kramer, would you like to fill us in what the story then is perhaps in Germany with the Greens coming to power? What can we expect also in terms of costs for the corporations?
Yeah, well, cost of the corporations, when you look at German producer price inflation, it is in double digit, and it is as high as in the 70s. As regarding the price for CO2, you can be sure that whoever leads the German government, CO2 prices will move up. And I expect the whole climate policy to raise the inflation rate in the next 10 years on average by nearly half a percentage point. And this in Germany. And there you see, I think you have to be honest with the people. We are all in favor of climate protection, absolutely. But I think we should be honest to tell the people that if we redirect resources, towards producing a better climate, then this of course means that we have less resources to produce classical consumer goods. And in some way we have to pay a price. And the huge or the excellent performance of the Greens, please do not forget, this is the best result ever at a federal level. And this means that carbon taxation and all this will remain a source of inflation going forward.
In other words, or to put it more bluntly, I could summarize there is no such thing as a free lunch. And somehow we knew that even beforehand. We are just about out of time. I am absolutely delighted with all my three guests and with their insight and what I think is an extremely insightful and high-level talk. So at the end here, I would like to do a lightning round, also to help our viewers crystallize what your main messages have been. You each get 60 seconds or less, and you are to tell the... Quit laughing, Rainer. And you are to tell the audience what you want them to remember from this evening. What was your main message that you want the audience to take home with them tonight? Davide, you go first, 60 seconds or less.
Perfect, thank you. We discussed about the economic environment here in the US. It appears in this week that we have some risks in the outlook that the market are assessing right now. However, I also want to stress the importance of extending the time horizon, and there are important sources of stability here in the US that this means that we maintain a positive view on the asset classes. Namely, corporates are in good shape, the households are in great shape. We don't see financial excesses building up in the economy. Financial conditions remain loose, and also monetary policy remains very data dependent, even if we have seen the Fed going in a little bit more hawkish than the market expected. What does that mean when we look at markets and how to invest? We still like equities. This remains our preferred asset class. We are here in the US, though, in an environment of more moderate prospective return. And actually, when it comes to equity strategy, we would prefer moving a little bit more international in equities. Also because profits can grow by more next year. We don't have to have uncertainty linked to the tax reform. And also we think that there is more room to catch up and more room for active management to outperform, given the wide dispersion we see when we move from the US to international markets. So overall, the environment remains a positive one. Of course, we need to be vigilant, monitor all the risk, and allocate very tactically. And we need to be really on top of what happens. As I said before, speed is alpha in this environment, and we'll continue to monitor the situation closely.
I think Peter was laughing here by my side. We may have a relative perception of what 60 seconds are, but that's quite all right. Dr. Kramer from Commerzbank, here we go. The Germans virtually invented time. 60 seconds or less.
Yeah, I'll make it within 60 seconds. Well, as far as central banks is concerned, they de facto lost a good part of their independence. This is especially true for the ECB, which is restricted by Italy's inability to implement true reforms, and therefore too much money will continue to come into circulation, and for the time being this will continue to inflate asset prices. How much seconds?
I don't know, I'm not checking my watch. You tell me. So are you done?
Yes,
you're done?
Yes.
Okay, very good, and thank you very much. Peter Brezinschek, please bring up the rear. 60 seconds or less. We have a question. Okay, we'll see. Okay, 60 seconds or less. Go ahead.
Okay. So what I would like to stress is here, we are in a very strong rebound of the business cycle going forward into the next 2 to 3 years, driven by gross fixed investments. That means we have strong earnings growth also for the upcoming years. That is a very favorable environment for equities. And this is supported by monetary policy, which is a supporter also of the fiscal programs, and means we have favorable financial conditions. Although, nevertheless, in the short run, we have to be more worrying about some developments on the equity markets of overvaluation, changing of the monetary policy, and therefore dips are buying opportunities for equities. That's my
We have one final question from the audience, and I hate to skip it, so I'm looking for a short answer. Perhaps, Dr. Kramer, I hate to keep you from dinner, but perhaps we can squeeze that in as an appetizer here. Given the EU's stance on decarbonization, what does that mean for competitiveness on a global level? Thanks for showing me that. The EU stance on decarbonization, will that hurt competitiveness of Europe on a global scale?
Well, it depends on what other countries will do, but I assume that the European Union will go ahead in terms of decarbonization. Of course, they would like to introduce a kind of tax or border tax adjustment system, but I think there are a lot of countries outside Europe who are likely to do less, and therefore, yes, we will pay a certain price for this, and I think we have to be realistic and honest to discuss this also on a firm level, on an individual company level. Of course, this is always a chance, because big changes in relative prices creates new business opportunity. But as I said before, this does not change the view that overall, in terms of pure monetary income, there's something to lose if you do more on this field than most of the other countries.
Thank you very much. Thank you, all three gentlemen, New York, Frankfurt, and here in the studio with me. It's been, to misquote the Queen, an undiluted pleasure to have all three of you. I've certainly learned a lot. I hope that you can take stuff home with you as well. I'm just going to be very brief here at the end. The Wall Street series is not done. Of course not. We're not even done for this year. We will be back in December with a Christmas special. That's all I'm going to say for now. As a little appetizer, I'm going to now hand you back to Rainer. He will see you out. Thank you very much, ladies and gentlemen, and see you soon.
Thank you, Monika. Thank you so much. Thank you, everybody. Thank you, New York. Thank you, Frankfurt. And thank you, all the viewers on all our channels, on Standard.at. Especially thank you to our media partner who streamed the discussion today live. And as I said before, if you missed part of this discussion, please go on our offers, on our digital offers, and you can watch it on demand. Thank you, everybody who is here. Thank you, everybody who was watching, and see you soon. Goodbye. Have a good evening.